Welcome back to the M&A Guy podcast. I'm your host, Brian Franco, founder and CEO of Meritage Partners and author of The Inevitable Exit. Today, I have a fun guest with me here today. We've done some work together. We're going to talk a bit about case studies. Ms. Jeanne Cummings. And this episode is titled From Founder to Scale Ready. And the work that Jeanne Cummings does within her network and also and within her collaborations with Meritage Partners. So, Jeanne, thanks for being here. How are you?
I'm great. It's great to be here. I've loved working with you, and I'm grateful.
Likewise. And you had a great event last night, so you're coming off that high and
absolutely
good crowd, good conversations. I think you led a panel. What was the panel again?
The panel, so it was Business Transitions Forum, and the panel that I led was increasing the value of companies both for real and on paper. And I had an incredible panel.
Yes.
Erica Sierra, who you know, personal client of yours.
Yes.
And she was a panelist.
Amazing.
And another gentleman, Parker Morse from Code Media.
Yeah.
Another guy who scaled the company. Erica's in the middle of scaling.
Yeah.
Yeah, and increasing the value of her company, and she's doing phenomenal, as you know.
We'll dive into those details.
Yeah.
That's really good to hear.
Yeah, Parker sold his company twice.
Yeah, well, good. So you had the two bites of the apple, so to speak, right?
Yes.
Well, I'm going to reference my notes because your background, I know you, but I want people to understand who they're listening to and why they should listen to you. So Jeanne, she's a strategist and leadership advisor, really who helps growing companies align leadership teams. She clarifies value drivers and builds systems and structures for scale. Her framework enables owners to reclaim their time. We know they want that. Mm-hmm. Reduce risk and position for sales, succession, or growth. And so, as I described to you, Jeanne, we do kind of these hot swap questions. So I want to roll through a few questions with you and let's speak to some of the experiences we've had together because, we've had some success together and intend to have more success together with a variety of clients. You ready to dive in?
I'm ready.
Let's go.
I love this topic.
Me too. Okay. So we actually, Meritage Partners, we brought you in with a particular client. They were looking to, the funny story is we sold her husband's client years ago, massive success. He's now fully retired. And now fast forward, the husband reaches out to us quite often and says, hey, sell my wife's company. I'm sick and tired of her doing payroll while we're traveling Italy or Europe or wherever they're going around the world, right? And so I says, okay, well, let's look into this. And so what we found and we discovered in that case study was she wasn't necessarily ready to transition the business, even though she was raising her hand and saying, I want to sell. I want to relieve myself of these duties and go travel the world with my newly retired husband, right?
Yes.
So let's talk about when you're brought into a company that's looking for that growth roadmap, or they're looking for, an exit or a transition in some capacity. What leadership or team misalignments do you quickly identify in the companies?
Yeah, I love the question because the first thing I notice is the disalignment of the CEO, the business owner.
Yeah.
And we were talking about this earlier. So a business owner, and I talk to business owners a lot about this. Yeah. I was just on a conversation with one the other day. We had a hard discussion. A business owner who is in the CEO seat, meaning they have not hired a president or a chief integrator or a CEO.
Correct.
And they are listed as the CEO. And two things are generally happening. They're micromanaging, right? And so when they're micromanaging, they're not allowing their employees to get the work done. And so they're usually losing A players, but they're managing because they don't have any playbooks in play, decision-making models, so they can't offer autonomy, right? And so then they're 10, 15, 20, 25 years in a company, and they're exhausted. They grew a company to 10 million, 20 million, 30 million. I'm working with one now, 50 million in revenue. Yeah. And they're working in the business and executing with everyone, and they're not doing any important CEO leading the people activities. And so oftentimes what happens is they might get exhausted.
Correct.
And they're tired of micromanaging. They can't handle it anymore, but they won't pass the torch and hire a professional CEO or president. And so now they start neglecting the company, and there's no leadership. There was never a good leadership, but
well, you find, I'll pick on myself, right? CEO of Meritage Partners. This is, you look at the org chart and you sit at the top. In my journey, I had the CEO title and role because I was the founder and because I was the leader, right? But when we started to look at this over the years, was I really the CEO? And the answer was no, right? And I recognize that. And so I always said to my team, I said, we need to fill the CEO role. Now, I would love to take that position, and here's the reasons why, and here's the qualifications. But today, I'm working in the business shoulder to shoulder with everyone else. And so we took me from where I was to where I'm now today. There's still this evolution, but that's what happens. Founders of companies. I mean, I remember at one time remember printed business cards?
Yeah, I do. I haven't seen them in a long time.
Everyone was so quick to put that title, CEO, CEO, right? And it was a badge of honor. Mm-hmm. It still is a badge of honor. But I think that people were so maybe the glitter and glamour of the title, they forgot, okay, well, what's that role look like? What does a CEO do? Don't you agree?
I do. And I get it because I've sat in the CEO seat of a couple companies, and the title is important because I'm able to get outside the company. I'm able to get some things done. I'm able to be invited to some important seats that help me drive the company forward. However, I am a hired gun professional CEO, whereas the founder, I can understand that title opens the door for them. However, they haven't been trained on how to sit in that seat.
Correct.
Yeah.
And that's what you do.
Yeah.
So it's funny because that's exactly when we collaborated on the project we were describing earlier. We said, okay, we're gonna parachute you in, you're gonna work with this founder, and you're gonna fire her on day one. Mm-hmm. Right?
Yep.
And that's exactly what you did. I mean, there was more to it than that, but that was a starting point. So you fired her from her role in the company and you promoted her to that CEO capacity. How did you do that? And what did that evolution look like in that case study?
So a couple companies I've worked with where I did sit in the CEO seat, I did remove the founder day one. I took control of their companies, and I created a seat for them that they loved and they're great at. Yeah. And it's usually business development or innovation. 100%. And they should be in both.
They're visionaries.
They're such visionaries. Yes. In the case of Erica, I didn't take her seat. I worked along beside her. Mm-hmm. And we did work uniquely. We did weekly sprints. Okay. And we worked on the foundational aspects of her business, stopped the bleeding in some areas, put in a company-wide playbooks, and put in some very foundational stuff that I don't think companies are more and more starting to realize how important a purpose of a company is. It's part of a decision-making model. In implementing values, they're not just words on a paper. Correct. Right? Good values of a company are a differentiator. They also have 3 behaviors under anywhere between 3 to 7 values, and they're decision-making models. Mm-hmm. I mean, I've implemented purpose and values and a lot more than just that. Yeah. And when I'm teaching teams and they're stuck on a decision, I'll put those 2 things up and I'll ask them, so what do you think the right decision is? And they can come up with the right decision. Yeah. And so we spent a good 5 months together just actually putting strategy in place, next level strategy, putting together a long-term plan and a short-term plan to execute on. And then started implementing. Yeah. And so we got it going. And the goal with that was, which it goes back to the first question, is how can we put this company in a place where we can attract an A-player chief integrator? Because that was critical. And Erica really saw how she really got that it was important for her to get out of the way. And I'm quoting her yesterday, actually.
Yeah. Okay, good.
And, to get out of the way and hire the right people. And she has an incredible team.
She does.
In terms of executors and managers.
Yes.
So we gave them the playbooks and the seat accountability and the right KPIs to level up. And they did. They were hungry for it.
Yeah.
And we've got a new chief integrator, and I just sat in their 90-day. They are over exceeding the whole plan.
All the expectations. Yeah, I remember, correct me if I'm wrong, but I think within the first few months, they 3x their appointments. 5x their appointments by volume.
Yes.
And that's because you went in there and you took out those areas of, I call friction, right, in the business. Like, we're constantly looking at what areas of friction do we have in our business, and then we work on, leaving those or removing those, or just so that it flows much more naturally, right?
Yeah.
And so you went in there and you removed those areas of friction quickly within months, 5x the volume of appointments.
Yes.
And where's it at today?
Well, so last year they closed at 6.7 million in revenue.
Okay.
This year they're going to close at just over 8.
Wow.
And the goal that we set for them in July 2025 to July 2026 was 10 million in revenue in the trailing 12 months. And they're probably going to get there a month early. So they're tracking. And Erica, guess what? She's in the business development seat. Nice. She's alive and excited again. Yeah. She's re-energized in working with her company. Wow. She's got this great chief integrator that she loves working with, who's, knows Crystal really knows how to run a company. She's phenomenal.
Yeah, that's good.
And they're getting to conferences and,
getting the word out there.
As you know, they did have a customer concentration issue.
Yeah.
And they're already attracted 2 major players that has pulled them out of that risk.
So it's diluted their key customer risk that we found prior. And just to give some background to the audience, we spend time using our assessments, valuation tools, and assessments. And we look at those points. We simulate what that business would be valued at in the market, how the market would perceive it, and then we pick and choose. Okay, well, here are the problem areas, and customer concentration is one of them.
Yes.
And I think at one point, it was about over 70%, let's just call it. And so we said, okay, don't fire that customer, just dilute them by bringing in other like customers. And so it's great to hear that she's doing that. And she's doing it with a great team that she didn't have before she met me and then you.
Yes.
And then you specifically going in there and doing the work. It's a massive success story, and I'm happy for Erica and happy for you and the outcome that's to come, because ultimately, which kind of leads into the next question is, how does this impact enterprise value? And so when you think of it, revenue's growing, great. Profitability will follow as well, great. But when it comes to selling a company or finding a growth partner to take it to 20, 30, 40 million and beyond, the business needs to be transferable. And transferability falls in, systems. Systems are transferable, right? People working the systems are transferable, but people by themselves are not transferable. Specifically owners, key person issues that we commonly see in these companies. And so the fact that you've done all of these things, taking out the points of friction in the business, enabled her to bring A players into the business.
Yes.
Now she's doing what she loves, and we both know this, but she loves business development. She's passionate about the industry.
Yes.
And she likes to talk about her experiences and how she started the company, how she built the company, and now she's delivering her services to the marketplace. And it's really cool to see. So
it's
kudos
really,
to both of you.
Well, and I'll quote her from yesterday. And if you remember when we were talking originally with her, and we were saying, wouldn't it be great if we can get you out of the running the company and just put you in business development? Yes, all that. And she was even a little bit hesitant on if she had the energy to do business development. I'm quoting her yesterday. She's like, she was in a place where she would pay someone to take the company over because she was that exhausted.
Yeah, yeah.
And now she's having a good time. She's increasing the value of her company, which we're getting into, as you talked about. And she's going to, when she's ready again, you're going to talk about how she's going to sell it for more.
Correct.
But quoting her yesterday, she is amazed in such a short time, by the way. It doesn't take that long when you get to work and you have good strategy and planning.
Yes.
She's amazed at how she's not, running the company.
Correct.
She's doing business development. She's amazed at how, especially her president, in the last 5 months, the entire team has worked to be capturing everything that's in their heads onto paper, right?
Or into a process.
Into processes. Yep. So that's scalable. Yes, and the KPI, the key KPIs that lead to revenue, everyone, the entire company is aligned to. Everyone knows their KPI, their specific KPIs and the main company KPIs, and they're energized towards it.
That's really cool.
Yeah.
And the thing about what you said is, yes, you took it out of their minds and put it into their systems or into measurable, measurable KPIs is what we're talking about.
And one other thing,
it's IP. It's intellectual property.
Yes.
So you didn't do brain surgery, but you came close to it by extracting what was in their minds.
Yes.
And putting it into the intellectual property of the company.
Yes.
Which increases valuation.
Yes. And so actually the first month that I worked with her, that was my job to get her IP out of her head.
Yeah.
And then now the president, and she's hired a couple key people. She's hired, the chief integrator. She hired a key controller, right?
Great.
They've got a 13-week cash flow, and she's excited about that. But on one of the first parts of executing in the first year was to capture everyone else's intellectual property on paper throughout the company. And so they're doing that.
So last topic, and I'll kind of do a tie back to what we've been talking about, and because we meet founders and owners that they want to scale their company, they want to sell the business. Usually it leads with, I want to sell it. And then we go through this simulation and said, okay, here's what the market is likely going to offer you. And they say, well, no, then I want to scale it first, is a response we at times get. And so in scaling the company to hit a certain valuation target is key. But not all founders are really ready, and even what they think they want is not necessarily what they need, and such as an exit, right? But when you go in and you scale the business, you do this download and you figure out what's there, what resources exist and what doesn't, and you implement those. But they also need to understand this one very answer to this question that I ask often. If you want to exit, great. But what are you exiting into is what I ask. And so when they start to identify what they want to exit into, and at times, like in Erica's case, I could imagine that when we do go to market one day, she's going to want to play a role at some capacity for a period of time. And that role likely would be BD, right? And that role would allow her to exit into something that she enjoys, she's passionate about, and it energizes her, doesn't drain her, right? So how do you get to helping founders understand what they want to exit into?
So, okay, so I think I need to brag about you for a second.
We have all the time. Maybe we can extend this 2 hours if we need to.
Well, because how I help them. So I help them. So you and I both play a part in this.
Correct. Yeah.
So first of all, when I start working with them, it's interesting to me that they don't have a vision for the future of their company.
Yeah.
And they can't think much greater than what they need to.
Yeah.
And we sit down and do a lot of work on that. And we're putting together a 10X or a 5X plan, which could be 2 buyers out.
Absolutely.
Right? But they're executing on it now. And so now, and we're creating opportunity for the founder with their wealth, right? we're affecting their lives because they're in a seat that they love. And we're affecting every employee in their company.
That's right.
Because people are excited to come to work again. And there are opportunities inside a company. So they're not going to leave now, right? So they're creating opportunities in every way. When it's time to exit, and this is where I want to brag about you, because I get to sit with a lot of M&A advisors, and a lot of them are so just, they love meeting that founder that's really exhausted and let's transact today. Let's sell your company. And as you put it so eloquently and perfectly, yes, if you want to really exit now, let's do it. However, what if we did a couple things and we increased the value of your companies? And I know that's why your clients love you so much. I've been to so many of your events and past clients, and they brag about you. But I think what's important is how many owners I've talked with that sold their companies and either had to buy their companies back, or they're just sad at what happened to their companies. And, Erica's husband, Jim, you sold his engineering firm. I remember the first time I met him and I asked him about working with you. And he's like, you know what? We found the best buyer at the best time. He stayed working inside his company for 5 years.
And he was only supposed to stay for 2.
And 5.
5 years later.
And he had the time of his life.
He did.
He had a great time.
I think they 3X'd the business in that 5 years.
Oh my gosh.
Correctly.
So, and he still is in touch with the company, and he's still pleased at how his employees are being treated, the growth of the company that's existing and the opportunities. And he's very proud. He's still working on his retirement, right? Like being a better golfer. But as you said with Erica, I think where I come in is I'm helping them with a new vision for growth. And you are more helping them with that, when they're finding the right buyer, where they fit in.
Correct.
Because that is going to determine the right buyer.
It is.
Is that right?
100%. And not only the right buyer, from a cultural match and also from the standpoint of, where do they see themselves post-closing? And so, and we can't blame other M&A advisory firms out there because they've been trained to be transactional. And to be transactional, you need to look at numbers. And from numbers, you'll produce a structure for the transaction. Since I started in this industry, I started when I was 24 years old. I was a kid. When I started this firm, I was 26. But what I even understood back then is that, yes, there's a transaction to be consummated, but there's human beings that are involved in this transaction. So yes, there's numbers, but there's also humans. And those humans need to understand what's around the corner. So we liken ourselves as the Sherpa as we take them up to the highest peaks of the mountain, right? We need to know what's around the corner. We need to know how much food we need and water we need to take with us. We need to know when we need to rest and when we need to push. It's because we've been there and we've done that, we can sit with our clients and we say, okay, yes, you want to exit, great, but here's what you're not thinking of, and here's what you should be thinking of, because the outcome would ultimately be much more satisfying and gratifying to them if they understand all these things. Now, they will eventually understand these things. It's usually post-close. And I heard a really cool stat recently. I'll give you multiple choice. The high of a sale for a founder after they sell their company, is that high last 6 months, 6 weeks, 6 days, or 6 hours?
6 hours.
6 hours. 6 hours. I was surprised, actually. I thought, well, maybe 6 weeks, like a month later, a little over a month later. But it's 6 hours, because then it's like, okay, well, now what?
Yes. And
right?
Yeah.
And so the now what is, right? The now what is answered before you ever go to market. Because to your point, if you're going to 3, 5, or 10x the business, you're going to, at some point when you transact on that linear timeline, you may be in the middle of the 3xing or the middle of the 5xing. But it doesn't matter when your transaction is. What matters is you have a pathway to get to that intended destination. And if the transaction provides for capital or liquidity or a combination thereof that allows the founder to get there faster with less risk by taking that liquidity, diversifying their investment, And every wealth advisor is going to tell you
Yes,
this,
yes.
right? Because when you look at the pie chart that wealth advisors always put together, there's stocks, there's bonds, there's cash, there's real estate, and there's this big piece of the pie, which is the business.
Yes.
Which typically and admittedly most, they kind of like guess, $10 million, $15 million, right? Number one, that number needs to be tight and accurate, but also when you're life planning and your wealth planning, the work that we do, yes, it becomes transactional, but really that planning becomes more, it's more relationship. It's more helping people understand.
You're hitting, yes, you're hitting on a couple things. So one is, and I have this saying I repeat a lot, which is people are important.
Yes.
And the way that we put that into action is communication.
100%.
And so, people are always surprised that when I go and work with companies, there's such fast impact. Talking with Erica yesterday, she is surprised how much we've done inside the company in under a year.
Yeah.
Every business owner I've worked with, I remember I was in a manufacturing company and the business owner said, I never could have imagined we would have done this amount of work in this amount of time.
Yeah.
And
I want to stop you real quick on there, because when you were specifically pitching Erica on what you're going to be doing, it's hard to say, right? You know what you're going to be doing, but the outcome could be a multitude of directions, right? You typically go after the lowest hanging fruit first, but it's hard to pitch that up front until they've lived it.
It's so true. And the reason, though, which relates back to what you just said, we're able to make that much impact is because we treated people with importance, meaning we were transparent in communication. And the way we roll out playbooks, we know what we want to roll out, but we're also getting buy-in, and there's a way to work with people across, large teams. If it's 50 people, 200 people. And so there's a book, The Speed of Trust, and that book,
great book,
is real. The other thing that you're hitting on is the wealth. Okay, how many business owners have you come across, and I come across them, really are told, oh, in your industry, in this code, you're going to get between this and this multiple. And they really think, oh, that's what we're going to get. Yeah. And so then they go into the value drivers and detractors. I mean, what do you say to them when they're shocked, when they...
Well, so there's two dimensions you need to look at. Yes, headline valuation, which is going to derive from a multiplier of EBITDA. And that's not too difficult to access that data. But then, what's more complex is, how is that valuation or that headline valuation going to be paid out, right? Is it all cash at close? Is it 50% cash at close? Is it 80% cash at close? And so it's really hard to tell. Most advisors can't answer that question because they will say, well, we need to let the market respond. And I think that's dangerous advice, because now you're putting your future at the mercy of someone's opinion out there. So when we bring a client on, when we work with a client, we're thinking like the investor, because we've been the investor, right? We've bought companies, we've sold companies, and these are our own companies. Yeah. So we think like the investor. When you think like the investor, you could quickly identify, okay, that's a risk, I need to solve for that. That's a risk, I need to solve for that. And so when you talk about downloading, we went through the same exercise internally. We created our AI tool called applebytes.ai. And applebytes.ai was designed to really do what I do in my brain from my years of experience. And that is, I identify these things. And so we can show them. We can not see into the future, but we can look at their business through the optics of an investor and quickly identify these are areas of risk. And so now some risk or perceived risk is going to be difficult to resolve until the transaction occurs, such as you're a single state operator working in, the geography you've been working in the last 20, 30 years, whatever it's been. And that's it. Like, you're not going to go and start an operation in Florida and Texas and, pick a state in the country. However, but when they go to transact, we're going to look for a buyer, an investor, where we find 1 + 1 = 3 or greater. And when we find that, likely those companies will have offices in those regions, in those territories. So then we could cross-pollinate those customer bases and those relationships. And so we can easily solve that with a transaction, but investors know this already. They know they could cross-pollinate. They know they could have that geographic reach if they just bought this one company in this area. And if we're that subject company, that's one area of perceived risk and actual risk that can be resolved by way of the transaction.
You're just reminding me of a story that's this week. So I go to a local coffee shop, 7 a.m. in the morning. And so that's when all the very successful go-getter, they're later in life, very successful guys who have sold companies or haven't yet, but I was there this week, and Jeanne, what are you up to this week? And I'm on, I'm going to be at this business transitions forum talking about this topic of increasing the value of companies, and through value creation and detractors. And they're like, yeah, maybe it's usually the market. So I'm like, I just let it go. Next day, one of the other guys, different guy, kind of said the same thing. And I thought, okay, so a market changes, right? COVID happens, or there's a
tariffs,
anything. However, you just said it. What happens with the de-risking of a company is going to determine how many people are going to come knocking at your door as well, right?
Right. Yeah. De-risking really comes by way of, to your point, de-risking of a client's company can come by way of synergies from the acquiring party, or it could be by planning and working on those months before, if not a year before, going to market. And Eric is a great case study of this, because we collectively, identified what was wrong. You came in and de-risked the business for her and with her. And so when she does go to market one day, those areas that were risky initially won't be an issue in the future.
Not at all. And I mean, for the business owners listening out there who don't understand how de-risking translates into discounting and what that means for their bank accounts. Yesterday, Parker, he sold the company for the second time at $400 million. And we were talking, so he had another chance. He knew, the levers and where the discounting happens. And so the second time around, that's a big deal to get a 10 multiple versus an 8 multiple because of the de-risking that happened. And what that means to not only just him, but his team.
Stakeholders.
Investors,
Yeah, because you can, just by simply getting to size and scale, or what we call critical mass in the market, you can drive a higher valuation just because of that. Now, you obviously, the bigger you get, the smaller problems become magnified too. So we can't ignore that. You still have to fix those things in the company. But
okay, so hold on.
Go.
One question that I didn't throw out to my panel yesterday, which it's been on my mind.
Okay, tell me.
It's revenue of a company isn't important, but it's important.
Okay.
Right? So you know what I mean?
I do.
So I would love to talk about that for the business owners out there, because there's the revenue, there's the EBITDA, and then there's, the value drivers.
Yeah.
And so why is revenue important but not important?
So when you look at valuation history and before my time, I mean, I was alive, but I wasn't advising when I was 10 years old. But in the 80s, you had valuation methodologies that derived by a multiplier or a dividend of revenue. EBITDA is not necessarily a measurement that was made, right? It was revenue. Because back then, when you study companies, it was assumed that those companies would profit 25, 30% of their revenue, okay? Now that's changed over the years, over the decades. And so companies can generate billions of dollars and lose money, break even, have a 2% profit margin, which would be terrible in a smaller company. So not all revenue is created equal, right? Because then you go into the subject matter of, okay, is this project revenue, meaning one-time revenue? Or is this reoccurring revenue by way of a license, a software, monthly reoccurring revenue, annual reoccurring revenue, contracted revenue? So not all revenue is created equally. So the market's really shied away from looking at revenue. So it does matter, but it doesn't matter. But what really matters is the predictable nature of that revenue. That's the key. Because with predictable revenue streams, investors can forecast, lenders can forecast, they can underwrite based upon the performance of the business historically, which is secured by contracts, licenses, right? And software companies are known for this. Yeah. This is why when people look at software companies and they say, wow, look at that. I would love to sell my business for the valuation of a software company. And I'd say, well, you can.
Yeah.
What do you mean I can? I don't sell software. No. But if you can convert your revenue from project revenue to recurring revenue, you can certainly derive valuations at the same multipliers that software companies are accessing. Like look at a blue collar industry like HVAC, right? HVAC companies for years were project-based companies. And then they rolled out monthly reoccurring maintenance contracts. So every month they would come and they would maintain the equipment for predetermined price every single month. What the cool thing was is it now moved their revenue from project to reoccurring, and reoccurring over time became the larger share of the revenue. But the project revenue that would follow was coming because they were on site doing the maintenance work.
Yes.
So they say, okay, well, this was maintained, that was maintained. We did notice a problem with this system and that system. That one you're going to have to replace immediately. This one you should forecast to replace in about 3 to 6 months. And so, but they were the first on the scene to be able to access that project work. So project work by itself is less valuable. Project work deriving from a maintenance contract is as valuable because it's coming from that contracted relationship. Predictable revenue stream. That's the theme in which we're talking about.
Yeah.
So to answer your question, that's why revenue matters, but it doesn't matter.
And what do you say? So I work a lot with companies between 10 million and 100 million in revenue. We're going to put in a 10x or a 5x plan.
Correct.
But we've got a lot of $5 million companies out there that are stuck, right? What do you say? What do you say to them in terms of, are there certain investors that are looking at, hey, we're going to start looking at you when you're at 10 million or when you're at 50 million? Yeah. Or is that an area also where revenue matters, but obviously it doesn't matter once you're...
Yeah, of course. Yes, there are institutional investors in the marketplace that they will raise millions, if not billions of dollars of capital to be deployed into businesses. But in those rules that they've raised that capital in the underwriting guidelines, the investor said, we'll give you these billions of dollars, but you cannot invest in a company if it's less than this threshold. And sometimes that threshold is revenue.
Yes.
Right?
Yes.
Mostly it's EBITDA, but in some instances it's revenue. And so they have a mandate to go buy companies that are larger. It's not necessarily that they are not interested in the smaller companies, because they are. And those smaller companies could be an option for them as long as they have that platform investment.
Yeah.
And they could acquire those smaller companies as add-ons. That's okay. But to acquire a $5 million revenue a year company as a platform, that's why you don't see it. However, there's something since last year that's been happening, and that's universities are teaching ETA, entrepreneurship through acquisition. Right? Because we've discovered, and VC companies know this, venture capital knows, like startup companies are risky. 9 out of 10 of them are going to fail. Right? That's why if you're going to invest in VC, you don't invest in one company, you invest in 10 or 20, because 9 out of 10 of those will fail. But what's been discovered is that existing companies that were owned by and have been owned by baby boomers for decades, right? They're coming to an age where they need to retire, they need to sell their businesses, but they've been operating their business the same way they operated them in the 80s and the 90s and the early 2000s, right? And so they're being taught how to acquire these companies, how to structure the financing, which is usually leveraged buyouts. And they acquire these companies and advance them with technology, tech-enabled, could be AI or a combination thereof. And so that's a big opportunity. So what was birthed out of that, they used to call them, they call them now independent sponsors. Prior, they used to be called fundless sponsors. But who wants to talk to anyone that has the title fundless?
Right.
Like, it's like, okay, yeah.
It's both
You're wasting my
fundless
time.
and funless.
Yeah, exactly. Yeah, there's no fun in that, right?
Yeah.
Like, show me the money, then let's have some fun. So what happens is those fundless sponsors are now rebranded as independent sponsors. So they're still backed by private equity groups. Think of them like a star athlete that a team wants to back, right? So they're going to give them big signing bonuses. They're going to say, come work on our team. And so what they'll do is they'll invest in any company they target and they help them grow that company. And so those independent sponsors are the ones that are now acquiring those $5 to $6 to $7 to $8 million companies, knowing that they need to get it to 10, 15, 20, 30 million of revenue, knowing that the second bite of the apple for them, and if the former owner holds equity with them, once they get to that critical mass, they could go to those institutional players because they know what those institutional investors are looking for. So with that end in mind, they build the business with the intention to sell it to a later stage equity group. Pretty cool, huh?
It brings up so much opportunity that's out there.
There's a lot of opportunity out there.
Yeah.
So we'll keep working together and working on those opportunities. Hopefully those that tuned in today really got a taste and a flavor for what you do. Those that are interested in speaking with you and talking to you, how do they reach you?
Oh, if you go to my website, jeannecummings.com, you can click on the Connect with Me link.
Perfect.
And my email is jeanne@jeannecummings.com.
Beautiful. We're going to put some show notes in there so they can reach you. And I'm sure they will, because we've been delighted to work with you, and and so have our clients. So thank you for
thank you for this opportunity to speak with you today, and it's a delight to work with you and your team. Yeah.
Always. We'll love to have you back as well. We'll talk about the next case we work on.
Yeah, thank you, Brian.
Thank you. And thank you for tuning in and listening to this episode of the M&A Guy podcast, brought to you by applebytes.ai, a tool that we described during this episode. Take a look at it and you will learn how to understand what your valuation looks like and what you could be doing to improve the transferability of your company. I'm your host, Brian Franco. Thanks for joining, and we'll see you next week.